Welcome back, investors. Jake here. In this video, I'm going to be taking a position in a company that I've never owned before and never traded before, and that company would be Amazon. And if you've been an Amazon shareholder the last year or 18 months, you're probably pretty frustrated. Over the last 1 year, Amazon's share price is only up 7.2%, and that's with the humongous rally it's had since March 8th. On March 8th, Amazon's share price reached a local low of 2,720, and it's up over 20% basically in under a month. So I wish I had, bought the dip 3 weeks ago, but you can't worry about that. So let's compare all the mega caps with Amazon over the last 1 year only being up 7%. Over the last year, Microsoft is up 29%, Google is up 38%, Apple is up 43%, Tesla is up 56%, Nvidia is up 120%, and even Berkshire Hathaway is up 42%. So Amazon's shareholders have been getting frustrated, and I think the board of directors is finally listening and taking action because Amazon has announced a couple things. The first one being is that Amazon is doing a 20-for-1 stock split to make their share price more manageable. I personally have never owned or traded Amazon because I like trading call contracts, and one call contract at the money for Amazon is like $30,000. So obviously I'm not going to be trading options on Amazon until the share price is a bit more manageable. I know I can still do credit and debit spreads, but I like owning full contracts. Additionally, they're going to use some of their cash flow to repurchase about $10 billion worth of stock for a company that is worth $1.6 trillion. This isn't a lot of money for a buyback, but it is signaling that Amazon's board is trying to look out for their investors. They're trying to return just a little bit of company profits to their investors to give their share price basically a jolt in the arm. Let's look at Amazon's fundamentals first, and then we'll look at their technical charts. And there are certain companies in the S&P 500 where it's hard to evaluate them comparable to traditional metrics like price to earnings. The reason why is because companies like Costco, ServiceNow, Salesforce, Amazon, they're so focused on reinvesting everything into the company in order to grow revenue that they're not optimized for making profit yet. They're not focused on returning profits to shareholders by paying dividends or doing stock buybacks. They're just focused on growth. And it's, alarming to see Amazon, a company already valued at 1.66, still focusing on growth, but that's been what's been successful for them basically the last 20 years. So when we look at their revenue growth, there's only 5 companies that can compete with what Amazon does in quarterly revenue. But last quarter alone, they brought in $137 billion in sales. This was a 9% year-over-year increase from the fourth quarter of last year. I think everybody can logically say that Amazon benefited a little bit from the pandemic and everybody staying home and ordering stuff. So potentially over the last year and a half, 2 years, they basically front-loaded some of their sales, and they're now starting to basically level out to what their natural growth probably would have looked like. And let's go to shares outstanding. Once again, just showing you that for the longest time, they've been issuing new shares. They've been issuing new stock as they grow. But now that they're a larger, more mature company, and I'll explain what's making them so profitable in the near future, they're trying to, once again, reward their shareholders. And for the first time in a long time, it looks like they're going to be repurchasing stock. When we go to net income, this isn't going to look that great. And this right here, guys, shows you the whole story. From 2010 to about 2017, do you see any positive net income consistently occurring for Amazon? And there's not, because every dollar they bring in, they spend it on the company. They reinvest it in order to keep growing. It's only in recent quarters that they've been posting positive net income. This 14 billion is because they took an investment in Rivian, and at their IPO, they got a really good price. So this was kind of a one-time thing that isn't going to look good for their quarterly earnings report a year from now. So let's go to the price ratios. And once again, it's hard to evaluate Amazon on price to earnings because their P to E is 50. But this company isn't trying to maximize their earnings, so that 50 doesn't really mean a lot. Same thing with price to free cash flow. If we look at their free cash flow, it's 0 because they don't have positive free cash flow apparently the last 2 quarters for whatever reason. So for the longest time, people have been evaluating Amazon on its price to sales ratio, which is what you use on, small cap companies that don't have profit yet and are focused on growing rapidly. Currently, their price to sales ratio is 3.58. Historically, you could argue that's where it's been valued going back to 2015. But another metric that nobody ever talks about on YouTube that I want to show you for Amazon is their shareholder equity. And, going back 500 years to the origins of shares and capitalisms and capital market, the reason you buy stocks is because you're buying a share in the equity of a company. And nobody even looks at this really anymore, but the equity is defined as assets minus liabilities, the value of all the stuff in the company minus the debts and obligations that company owns. That is what you technically are supposed to be buying when you buy and sell stocks. But at some points, people realized that it was better to buy and sell stocks on the future value of the company equity. So we use ratios like price to earnings, price to sales to gauge what is the future equity of this share going to be worth. But let's go ahead for fun, look at shareholder equity and its tremendous growth. Once again, this is the value of all of the stuff that Amazon is. This is the company worth. And the equity of Amazon is $138 billion. And look at how they've been growing their company equity quarter after quarter as measured year over year percentages. Consistently 40%, 38%, 58%, 34%, 58%. So Amazon knows how to grow. They're not extremely profitable because they're not optimized for profit. But as far as taking care of their shareholders by consistently growing shareholder equity, by not taking on too much debt, spending their money responsibly, Amazon is a fantastic company, and this is really the only thing you need to look at to see that. The other thing that has Amazon shareholders excited, first quick one, is they raised the cost of Amazon Prime membership by like $10. That's basically pure profit for the company on their delivery service operations. But Amazon Web Services is basically a company within a company. And for the longest time, this wasn't profitable as they were building the infrastructure and developing it. However, in the last couple years, Amazon's Web Services operating income has turned profit. This is in millions of dollars. This is their quarterly earnings statement for the last quarter. So in 2020, in the third quarter, operating income, so positive money from their operations, $3.5 billion. Good job, Amazon. You actually made money on something. And they grew that to $5.2 billion. The tech side of the business for Amazon is obviously high margins, very profitable. So as they focus on Amazon Web Services, they can finally start making a profit on something. Here is how they did basically on their, Amazon, selling stuff on Amazon.com. They lost $206 million. They couldn't be, operating income positive. And for international, they lost $1.6 billion. It's a very strange business model when you're the largest retail seller in the country and you can't make money doing it, mostly because they're not trying to. But with Amazon Web Services, this is what has Amazon investors the most excited. Let's now go to the charts for Amazon, and honestly, this is a hot mess, guys. Amazon's share price reached $3,000 a share back in July of 2020. So for almost 20 months, it's just traded sideways in this range between a high of 3,800 and a low of 2,800. So about a $1,000 range. And it just goes up and then goes down, goes up and then goes down. Longer term, is there a slope similar to some of these other mega caps? And actually there is, going all the way back to February of 2016. So 6 years. There's 1, 2, 3, 4, 5, 6, 7 points of contact. And potentially that's all that Amazon's stock has been waiting for based on the technical traders or the computers. They're just letting this trade sideways until this upward slope can give it support. Potentially not. You know, these upward trend lines, they're fun to spot, but not necessarily anything reflecting the actual fundamentals of the company today. When we zoom into the last 6 months, Amazon's share price was locked in a downtrend, similar to the rest of the market. Going back to November and December, Amazon's share price peaked at 3,758, and it got as low as 2,665. When it hit this level of support, going back basically 20 months, I was interested. I was looking at it. I even mentioned it a couple times in some of my previous videos saying, wow, that's kind of a dramatic sell-off for a company that continues growing its revenue. Potentially, this is a good place to buy. It then snapped back up to this 3,200 level, which was a line of resistance prior to this last week. It then sold off again. And I had drawn in this green line going back to basically the pandemic. And this level of support at 2,400 is where Amazon would have sold off if this sell-off during that week where the Fed announced their first interest rate hike, it would have sold off to here. So I definitely was being greedy, guys, trying to perfectly time it at the bottom, and I should have opened a debit spread. A debit spread is where you buy a call and then sell a call against it to make the price more manageable, because obviously a full call contract is insanely expensive on Amazon. And sure enough, like we said, Amazon over the last 3 weeks has gone up 20%, and it's actually entered this previous range of consolidation between 3,200 and 3,600, which is good if you're an Amazon shareholder. So what was a line of resistance here, as you can see, is now a line of support. So I'm going to make this the color green. Potentially in the next month, could it fall back through, go as low as 2,800 again? And yes, it can. But also, it can run. Now that we know this share buyback is happening, Amazon Web Services is growing their profitability. We got the stock split coming up. Amazon at any point could just take off, get back to this level of resistance at 3,600, potentially break through it, get to this level of resistance at 3,800, potentially break through it, and go to new all-time highs. I'm guessing it might get to 4,000 a share and then bounce off of that. I'm not sure. So what do I want to do? How do I want to play this, guys? And I'm not going to open a debit spread position because it's right in the middle of these two ranges of consolidation. So I just want to buy the stock. Currently, the share price is $3,275. I'm going to purchase 2 shares for $6,400. If Amazon breaks out and takes off over the next couple months, great. I'll make some profit on owning 2 shares of Amazon. I'll hold it until the stock split and then reevaluate it once I have the 20 for 1. So I'll have 40 shares of Amazon. However, if there is a sell-off at any point in the next couple months, I'm going to sell those 2 shares for a loss if it gets like down here to 2,800, and I'm going to convert that equity from selling the 2 shares at a loss into a debit spread because I'm confident at some point Amazon will rebound, get back to this 3,200 level or potentially even higher. When we check in with my Schwab account year to date, I'm only down 2.6% now, or about $1,600, considering how big of a hole I was in, down to 47,000. I'm liking the gains that I'm getting back over time. Let's get into my account and buy these 2 shares. Here is my account holdings, and you can see I purchased 2 shares of Amazon with a cost basis of $3,280 per share. If Amazon's share price over the next couple months dips back down, I'm going to convert this money into a debit spread to ride it back up. But if Amazon just takes off and gets to new heights, maybe $4,000 a share, I'll happily just take profits on whatever these 2 shares can do for me. The other position I want to quickly talk about is Google, because I basically did the same thing as I'm doing with Amazon. With Google, I opened a debit spread between the share price values of 2,600 and 2,700, and I'm currently up the difference between these two. So my long calls gained me 13,200, and the calls that I sold against them to make the contracts more manageable in price have lost me 11,500. So my profit is the net difference between these two positions, are about $1,800. Let's quickly look at where Google's share price currently is. And Google's share price is currently at about 2,830. So the calls that I sold at 2,700 are losing me value, as the calls that I bought at 2,600 are gaining me value. I technically can just keep holding this, and if Google's share price continues going up, my debit spread will keep making me more. As we get closer to the expiration, delta contracts and the debit spread becomes worth more money. But I don't want to hold this debit spread anymore because it's already blown past this 2,700 level. So I'm going to do the exact same thing with Google that I'm doing with Amazon, where I'm going to sell this spread for a profit today, then buy 2 shares of Google. If Google takes off and goes to all-time new highs in anticipation for their stock split happening in June, great. I'll take my 40 shares of Google once the stock split occurs. But if at any point in the next couple months Google sells off and goes back to 2,600 or 2,500, I'm going to sell those shares for a loss and reopen a debit spread in order to make more money. Let's go ahead and do that real quick. Okay, back in my Schwab account, and I've closed my debit spread position in Google for a profit of about $1,800. I then purchased 2 shares of Google, cost per share $2,832. I'm still sitting on about $12,000 worth of cash. Once again, I think the market will have a temporary pullback at some point in the next week or so, and potentially I will use the rest of this cash to open new positions. As you can tell, guys, I'm going pretty heavy on tech or the mega caps over this summer. I think when you look at the summer performance of the big tech stocks going back to 2020 and 2021, for whatever reason, they go up the most or run the most over the summer months. Why that is, I'll do some deeper research and potentially make a video about that in the future, but I'm liking my positions here so far, and we'll see if we can once again turn this account positive in the near term. Okay guys, if you enjoyed this video, give me a thumbs up so the algorithm knows it's good. If you have any comments or questions, let me know down below. I love hearing from you guys. Till the next video, take care.